The 2025 housing market is brutal to navigate, but it's not impossible if you know the real numbers. Today, I'm going to walk you through exactly what 3 different salary levels can afford for housing this year, with concrete monthly payment ranges for $40,000, $80,000, and $100,000 earners, plus the cities where your dollar goes the furthest. We'll also cover the updated lending requirements that banks are actually using right now and practical next steps for your situation. So drop your salary and city below so I can point out whether you should rent, buy, or move. But first, let me show you exactly why the math has changed so dramatically in the past few years. By the way, I'm Fred. I've been in the finance industry for more than a decade and have helped over 750 families with their mortgages. So current mortgage rates have been hovering around 6 to 7% and are fundamentally reshaping what buyers can afford. That same $300,000 house that cost you $1,200 per month in 2021 now costs over $2,000 per month. Same house, same down payment, but almost $1,000 more per month. Let me show you how this plays out with different loan amounts. Assuming a 30-year fixed loan without adding any taxes or insurance into the payment, a $200,000 mortgage jumps from $843 per month at 3% interest to $1,331 at 7%. A $500,000 mortgage goes from $2,108 per month to $3,327. These are not small differences, they're completely different monthly budgets that everyone gets affected by. So, if you're buying a $400,000 house with a $320,000 mortgage, going from a 3% to 7% means you're paying an extra $768 every month. That's over $9,000 more per year for the same exact house. Every percentage point matters when you're borrowing hundreds of thousands of dollars. Now, the Federal Reserve has made it clear that fighting inflation is their priority. And that means that rates are not going to drop back down as fast as we want, and they're definitely not going to go back down to pandemic lows anytime soon. Economic indicators suggest that we're going to be seeing rates in this range through the end of 2025 and potentially even longer, although some economists are saying that there's going to be rate cuts in the near future. Who knows? But what I do know is that this rate environment is fundamentally changing who can afford to buy homes, pushing many potential buyers into renting longer or moving to cheaper markets completely. But here's the problem with that rental strategy. Rental markets nationwide are hitting renters with sticker shock that's forcing major lifestyle changes. As a matter of fact, the national median rent sits around $1,942 per month, but that's just the starting point. Cities like Cleveland, Indianapolis, Raleigh, and Charlotte have seen double-digit year-over-year rent growth, while coastal and migration-driven markets remain the most volatile and expensive. Now, let's look at what that means in dollars. Major cities are pricing out middle-class renters entirely. New York averages $304,000 per month for a one-bedroom, although I've seen it go a lot higher than that. San Francisco sits at $3,200 per month, and Los Angeles comes at $2,900. Boston's running around $2,700 per month, Seattle at $2,500, and Chicago at $2,100. Even supposedly affordable cities like Phoenix now average about $1,950 per month. Other cities included are Denver at $2,300 and Nashville reaches at $2,000, although I think that's going to go even higher because more people are moving over there. Rent increases have far outpaced wage growth. We're talking about rent increases of 50 to 60% in many markets over the past 3 years, while wages grew maybe 15% over the same period. The gap is crushing household budgets. Large investors and algorithmic pricing are one of the factors pushing rents higher, treating housing like a financial asset instead of a basic need. Now, the average American earns about $56,000 per year. At typical rent levels, they need to earn about $85,000 to afford a median apartment without being rent burdened. Is it cheaper to rent right now where you live? That answer surprises a lot of people, and we'll compare that with buying later, but some markets have cooled down. Portland rents dropped 8%, and certain areas in Texas are seeing modest decreases as new supply finally comes in. So where does this leave people trying to make housing work on different salary levels? Let's start with a reality check. If you make $40,000 gross, that's about $3,333 per month before taxes. After taxes, that's going to be a lot less, and your take home is going to be substantially lower, leaving you under $1,000 for housing if you're going based off of the 30% gross rule. Even stretching to 40% of gross income only gets you about $1,300 per month. Now, let's compare that to actual rent prices we just covered. In smaller Midwest cities, you can find very cheap studio options or rooms in shared houses. In many Sunbelt or coastal regions, even modest one-bedrooms are well above what a $40,000 salary can support. At this point, you're making creative arrangements to make the math work with several roommates or whatever it may be. Assistance exists, but it's limited and competitive in many markets. Housing choice vouchers help when available, but the supply does not meet the demand in most areas. The reality is most people at this income levels need roommates or cost-splitting arrangements. Some rent rooms in houses, while others find apartments with friends to divide expenses. House hacking, where you rent out rooms on the property that you own, can be a long-term path but requires getting approved for a mortgage first or having a significant down payment to help. You can check state and local down payment assistance programs. I have a few that I offer with my lenders, but many states offer a first-time homebuyer program that can bridge the gap between what you earn and what your home costs. These programs vary widely lender by lender, but they do exist in most areas. So, home ownership at $40,000 is extremely challenging without family help or assistance programs. But there's a salary level where housing options open up dramatically. An $80,000 salary completely changes your housing game. Using the same 30% of gross income rule, your housing budget hits $2,000 per month. But here's where it gets interesting. Financial experts like Dave Ramsey, although I'm not the biggest fan, recommend keeping housing to 25% of take-home pay, which creates a much tighter budget than what lenders will actually approve. Now you're looking at actual payments in starter homes instead of just rooms. In Nashville, you can rent a nice 2-bedroom for $1,800 per month. In Denver, a nice 1-bedroom in a good neighborhood runs about $1,600 per month. And you might even find a small house for rent for $1,900 in cities like Charlotte or Indianapolis, or somewhere here where I am in Texas like Kyle or Buda. They're available. For buying, you are suddenly in the game. A $280,000 condo with 10% down gives you a monthly payment of about $1,950 per month, including taxes and insurance at current rates. That same payment could get you a $250,000 starter home in markets like Kansas City or Columbus. At this income level, you could afford a decent neighborhood instead of having to settle for whatever's the cheapest and maybe not the safest. Your debt-to-income ratio matters more now because you're actually going to qualify for a mortgage or try to. Lenders will often approve up to 43% debt-to-income ratio, sometimes higher, some go up to 50, 57, depending on the loan program. But what they'll approve and what leaves you financially comfortable are two very different things. Now look, whenever I pre-approve borrowers nowadays, I tell them that you're going to get pre-approved for a lot more than you're comfortable spending, so I ask them what their monthly budget is so we can reverse engineer the math and see what they'd want to buy. Just because you get approved for $400,000 does not mean you need to spend that because you might be house broke. The reality is $80,000 has become the new baseline for comfortable housing in most metropolitan areas, but there's a salary threshold where housing transforms from budget constraint into wealth building opportunities. At $150,000 per year, you're suddenly looking at houses that felt completely out of reach at lower salaries. At $150K gross, 30% of that is $3,750 per month. That usually opens up anywhere from $350,000 all the way to $500,000 as far as purchase options go. This does depend on down payment and current rates, of course. Now you can afford that $450,000 house with monthly payments around $3,200 to $3,300 per month. You're looking at 3-bedroom houses in solid neighborhoods, updated condos in prime locations, or even luxury apartments if you prefer renting. In cities like Atlanta or Dallas, you can get a beautiful 4-bedroom house for around $400,000. Even in pricier markets like Denver, you're accessing quality neighborhoods that were impossible before. Not only that, this income level opens up real investment opportunities. You can house hack by buying a duplex, living in one unit while renting out the other, which should cover a good chunk of your mortgage. It's not going to cover all of it with these rates, but it will cover the majority of it. This approach reduces your out-of-pocket housing costs while building equity at the same time. Some buyers at this level purchase their primary residence and keep their previous home as a rental property and make money off of that. But even high earners face challenges in coastal markets. That $450,000 house gets you maybe a small shack in San Diego or a fixer-upper outside of Seattle. Property taxes and insurance can also stretch budgets more than expected, even at higher incomes. A $400,000 house in Texas has property taxes of anywhere between $8,000 to $10,000 per year, which is insane. Smart strategies include buying below your maximum budget and using the savings to invest in additional properties or other investment opportunities. This $150,000 salary positions you to build serious wealth through real estate over time. Although they're saying $150,000 is middle class nowadays, I don't believe that. At least not yet. But here's the problem. All these affordability calculations, they're based on lending rules that might not work anymore. The classic 28-36 rule has been a lender guideline historically, used to determine safe borrowing limits, meaning that 28% of gross income for housing costs and 36% for total debt payments including that housing cost. This conservative approach worked when mortgage rates were 3% and home prices were significantly lower before COVID, but current lender behavior tells a different story. Actually, let's run some numbers with today's conditions. Someone earning $80,000 per year should spend a maximum of $1,867 on housing, according to the 28% guideline. With 7% mortgage rates and a conventional down payment, that qualifies them for roughly $240,000 as far as a home purchase goes. The median home price in most cities ranges from $350,000 to $500,000. The guideline creates a massive gap between what's actually safe and what's actually available. Most lenders now regularly approve buyers up to 43% debt-to-income ratio, and some push as high as 50% for conventional, with strong credit scores and strong cash reserves. Regional lenders in expensive markets approve ratios that would have been automatically rejected 5 years ago. FHA loans allow even higher ratios in certain situations, as do VA and USDA loans. But here's the huge distinction. What lenders approve and what keeps you financially comfortable are completely different things. 2836 rule still matters for certain loan types and serves as a useful conservative benchmark for your own budgeting. Just because you can get approved for a higher payment doesn't mean you should take it. Again, you don't want to be house broke. The reality is traditional affordability rules need major updates to reflect current market conditions. Here's my updated framework that actually works in today's market. The old 30-33 rule told you to spend 30% of income on housing, put 30% down and buy a house worth no more than 3 times your annual salary. This guideline is super impractical nowadays unless you still live in the 1980s. Let's break down why each part creates challenges now. The 30% housing rule assumes you can find decent housing at that price point, but if you earn $80,000 per year, you limit yourself $2,000 per month for housing. You've priced yourself out of markets where median rent hits $2,500 per month. You end up in unsafe neighborhoods or hour-long commutes just to follow an outdated guideline to get to your job. The 30% down payment rule creates even bigger barriers. On a $400,000 house, that's $120,000 up front on top of closing costs. Most buyers would spend decades saving that much while home prices keep rising faster than their savings rate. Meanwhile, they're potentially paying rent that's higher than a mortgage payment and they're not getting any equity out of that house. Research shows that while 20% down helps you avoid PMI, a ton of first-time homebuyers are successfully buying with 3 to 10% down. PMI on this is fairly cheap if you consider the factors. The 3 times income rule is impossible in most cities. Someone earning $100,000 should buy a $300,000 house, but the median home price exceeds that in 75% of major markets. My recommendation that works for today's buyers uses 35% for housing costs, 10 to 20% down payment, sometimes even lower, and 4 to 5 times income for purchase price. What you should do is focus on total monthly costs you can handle rather than arbitrary percentage rules. But even these updated numbers depend entirely on whether buying makes more financial sense than renting in your specific situation. The rent versus buy calculator looks completely different now than it did even 2 years ago. Higher mortgage rates and increased home prices have flipped the math in ways that surprise most people. Background research and affordability calculators now often show break-even windows of roughly 8 to 12 years in many markets compared to 4 to 6 years before the rates started going up. This happens because higher rates increase your monthly payments while maintenance costs averaging $200 to $400 per month, along with property taxes, HOA, insurance, they stack on top of your mortgage. Factoring closing costs that have increased with higher home prices and higher rates, renting often wins financially in the first decade. But here's where it gets interesting. Remote work creates opportunities for geographic arbitrage that can make buying attractive again. You can relocate to growing secondary cities with lower housing costs instead of paying premium rents in expensive metros. This strategy works great if you're not tied to a specific location or work. In many markets right now, renting makes more financial sense where purchase prices have gotten so inflated that monthly homeownership costs exceed rent by significant amounts. Miami, Austin, and parts of California show this pattern pretty clearly. The decision framework right now prioritizes flexibility, job security, and geographic preferences over simple monthly payment comparison. If you want me to run a quick rent versus buy scenario for you, drop your salary and your city in the comments and I'll go through that with you. But even when you think you got the monthly payment figured out, there are hidden costs that completely change your budget. That $2,400 mortgage payment that you budgeted for turns into $3,200 per month once you add all the real costs. Most buyers focus only on the principal and interest payment, then get shocked by everything else that comes with home ownership. Property taxes vary widely by location and can destroy your budget. Texas, where I'm at, has no income tax, but property taxes average between 1.8 to 2.5%. So your $350,000 house costs $6,300 per year or more in taxes alone. Some states keep property taxes much lower, but you'll need to research your specific area since these costs change dramatically by location. From what I remember, Nevada and Arizona have some really good tax rates. Now here's the other thing, homeowners insurance has jumped 20 to 30% in most markets over the past year. Florida homeowners pay $3,000 to $5,000 per year for basic coverage, while fire-prone areas like California see premiums hitting $4,000 or more per year. Even stable markets that used to have cheap insurance now average much higher costs. This doesn't apply to every scenario, but there are HOA fees and they range between $150 per month for basic maintenance to $800 per month for luxury communities with pools and concierge services, as well as people maintaining your lawn. These fees increase every year and you can't opt out. Maintenance and repairs average 1 to 2% of your home value annually. So your $400,000 house needs about $4,000 to $8,000 per year for upkeep. This isn't a guarantee, but it's always good to put that money aside in case something does happen. Closing costs now average 3 to 4% of the purchase price due to higher home values and also higher interest rates. Always add these estimated monthly buffers when you run your affordability calculator. Ignoring them is the most common budgeting mistake. But there are specific strategies that can help you work around these higher costs and actually improve your housing situation. The most effective strategy right now is getting your credit score over 720 or even over 740 before you start shopping. Small credit changes and improvements can lower your rate and monthly payment dramatically, especially on a $400,000 loan. If your credit score is below this, don't worry, you're not out of luck. There are a ton of options for you. You may just have to take on a slightly higher interest rate or a slightly higher PMI, but it's not going to be something that kills you. Now you can increase your credit score by paying down credit cards, disputing any errors on your credit report, and avoid opening new accounts for 6 months before applying. Before you start throwing money at your credit cards, talk to an actual lender. We can tell you exactly what you need to do to get your credit score to where it needs to be. Another huge tactic is something I'll call geographic arbitrage, and it works if you can work remotely. You can buy a 3-bedroom house in Cleveland for $180,000 instead of renting a 1-bedroom apartment in San Francisco for $3,500 per month. Cities like Pittsburgh, Kansas City, and Buffalo offer solid job markets with housing costs 60% below coastal areas. Research job markets in target cities before making the move. House hacking lets you live nearly for free while building equity. Buying a duplex, living on one side, or renting the other out. The rental income covers most of your mortgage payment. What you should do is calculate rental income realistically when buying a house and house hacking and factor in vacancy periods and maintenance costs. Down payment assistance programs exist in every state, but most people never apply. Ohio offers up to $15,000 in grants. Texas provides up to 5% for down payments with loans below market rates. Maryland gives $25,000 to first-time homebuyers in certain counties, so you should check your state housing finance agency for grants and programs specific to your area. Co-buying with friends or family splits costs and improves loan qualification too. 2 people qualifying for $50,000 each actually qualify for more than one single person earning $100,000. Partnership agreements protect everyone involved and make homeownership possible years earlier. Now, consider waiting or renting if the numbers don't work right now. Use an affordability calculator as an illustrative tool to run different scenarios. Remember, the pre-approval shows what lenders will approve, not exactly what you should buy or what you should afford or get into. The key is being realistic about what works for your specific situation. Housing decisions come down to understanding what each income level actually supports. At $40,000, you need a roommate or assistance programs. At $80,000, you get realistic starter options, but the location and existing debts matter. But at $150,000, you have much more choices and more potential for investment opportunities. Stop using outdated affordability rules when rates were 3% in 2020 and 2021. Calculate your actual budget using current mortgage rates and all of the hidden costs we covered. Factor in property taxes, insurance, maintenance before you make any decisions. Comment your salary plus city and I'll point you to the next best step: renting, buying, or another strategy. What you can do in the meantime is run the numbers with today's rates, check local down payment programs, and improve your credit. Those 3 moves most often change whether buying is a reality or a dream for most people.